Hey everybody, welcome. Thank you for joining me for this third quarter 2026. This is a quarterly review. We're going to take a look back at the second quarter. For those of you that haven't met me yet, my name is Matt Landon. I'm a CFP and the CEO of Semmax Financial Group. I'm really excited about what we have to dive into. So I want to go ahead and get started taking a peek at the 10 market themes for third quarter of 2026. We're going to be discussing several market moving topics and how they're going to impact your portfolio moving forward. You'll see here we're going to start off with a market recap, but I don't want to be one of those people that says everything you can read. So let's just jump into these slides. You're going to pick it up and you can always pause this video and kind of come back to it. So we're going to start off with a market recap. Let's take a look here at the S&P 500 index. This was during the second quarter, and it overlays the major economic and market events that shaped it. Here's the big takeaways. After trading lower in quarter one, the stock market staged a pretty powerful recovery in Q2, with the index gaining nearly 14%. This was a finish near all-time highs. The story of this quarter was really around strong improvement. As the oil shock and the Middle East conflict that weighed on stocks in Q1, that gradually gave way to some easing tensions. There were some strong corporate earnings and renewed enthusiasm around artificial intelligence. I have definitely got more to say about that in a later slide, so we are going to get into it. If you remember, the quarter opened with the market still under pressure from the Q1 sell-off, but the starting point would ultimately turn out to be the low point for the entire quarter. Oil prices, which has spiked to nearly $115 a barrel, that was in early April. They really fell due to the Middle East conflict down to below 90 kind of mid-month. That was because the US and Iran had agreed to a ceasefire. We will see where that continues to go. The diplomatic relief, the falling oil prices, that fueled a nearly 2-month recovery that steadily kind of gathered momentum. We had strong Q1 earnings coming in. We had a 40% plus semiconductor stock rally in April. That really pushed the index a lot higher. And then the month ended with the Federal Reserve holding interest rates steady in late April, though that meeting did produce the most policy dissent in over 30 years. Now the rally continued into May. Stock market settled into a steady climb, hit new highs. There was market volatility declining. That was as the conflict de-escalated. Earnings continued to impress. Kevin Warsh was confirmed as the new Federal Reserve chairman in mid-May. Index gained nearly 5% on the full month, and that capped off a 9-week winning streak. That rally carried into June, with the S&P setting a fresh all-time high, closing on June 2nd. But the final weeks of the quarter saw an increase in market volatility. Inflation data that was released in early June, that showed that consumer prices rose 4.2% year over year in May. That led us to a 3-year high, which was really driven by the spring spike in oil prices. Now, following the hot inflation report, the Federal Reserve held interest rates steady again on June 17th, but it signaled that its next move could be a hike rather than a cut. Questions about spending on artificial intelligence infrastructure, those started weighing on semiconductor stocks, which have become a popular but a crowded trade this year in the back half of June. Despite the market volatility, investor risk appetite remained strong. You saw things like SpaceX completing its largest IPO in history. It raised $85 billion. That's kind of an interesting thing to look at, especially when you look at what SpaceX stock prices have done since that initial IPO. Now, the S&P 500 had ended the quarter with a gain of approximately 14%. It had its strongest quarterly return going all the way back since Q2 of 2020, back during the early stages of the pandemic recovery when we had that V-shaped recovery. So we're going to take a closer look at each of this quarter's themes throughout this webinar, and that's including semiconductor stocks, AI infrastructure investment, oil and inflation, and the Federal Reserve. So let's take a quick peek here at AI-driven spending. Now, what I want to highlight in this graph is that the quarterly price returns of semiconductor stocks since 1996. Semiconductors are the advanced computer chips. They really sit at the center of modern computing and, more increasingly, the artificial intelligence build-out. Each one of these bars represents the price change over a single 3-month period, giving us nearly 3 decades of history in one view. And the story it tells is hard to miss. The bar on the far right, representing Q2 2026, towers over almost everything else that came before it. The semiconductor index returned 88% in Q2. That was its strongest quarterly return on record. To find quarters that even come close, you have to go all the way back to the late 1990s when semiconductor stocks gained 68% in the first quarter of 2000 and 65% in the final quarter of 1998. I would say what distinguishes the current move is the driver that was behind it. The rally was an artificial intelligence story from start to finish. The largest tech companies spending hundreds of billions of dollars on new data centers, the advanced chips required that are needed to run them. The semiconductor industry is benefiting from the spending, and you've got record earnings and growing order backlogs. A move of this scale is historic, and it deserves to be recognized as such. The market is treating AI as a major technological shift. And the thing is, the quarter brought increased spending and earnings growth, with companies signaling more spending ahead. At the same time, a quarter like this shows how much future growth has already been priced in. Over time, the spending is going to need to translate into real profits to justify the scale, especially because a growing share of this is being funded by issuing new debt and stock. The closest historical parallel, the late 1990s, points to what a rapid transformative change tends to bring, which is both real opportunity and high expectations. So what I want to do now is look into this AI CapEx. And if you see here, this is answering the question that the previous slide raised, which is why did semiconductors rise nearly 90% in a single quarter? The answer to that is that an enormous amount of money is being invested in artificial intelligence, and a large share of it flows directly to the companies making the computer chips. The two charts on this side, they're going to show you the AI infrastructure investment from two angles: how fast business spending on technology is growing compared to history, and who is doing the heaviest spending. The chart on the left graphs the year-over-year growth of business investments in information processing equipment and software. It's representing the amount of money companies are spending on computers, servers, networking gear, and software. In Q1 2026, tech spending grew by over 19%. It was 19.1% compared to the same quarter a year ago. This was a pace that was even faster than the late 1990s, when the arrival of the internet set off a comparable surge in technology investment. I think we all recall the dot-com bubble, and so there's questions there as well. Now, the chart on the right provides additional context at the company level. So this is graphing the combined annual capital expenditures of the 5 leading technology companies that are building this AI infrastructure. That would be Microsoft, Alphabet, Amazon, Meta, and Oracle. The bars show their combined spending each year going back to 2016, and the trajectory is, frankly, it's striking. In 2026, the 5 companies invested $32 billion combined. By 2025, that figure had grown to roughly $416 billion. So from 2016 to 2025, that number grew nearly 13 times as much. And this year, they're expected and projected to spend about $724 billion, with a spending forecast to grow to around $900 billion next year. The spending is what's paying for the data centers, the computer chips inside of them, the networking equipment that connect it all, and the electricity and the cooling required to keep everything running. So these two charts, they're the engine behind the semiconductor rally we just discussed. Hundreds of billions of dollars are flowing into AI infrastructure, and a large share of that spending goes directly to the chip makers, which help explains both the growth of the stock gains and the record earnings underpinning it. The semiconductor rally on the prior slide, it's anchored to actual spending, which is supporting not just the chip makers, but the data center builders, equipment suppliers, and the utilities power. The investment in AI infrastructure is grounded in real demand rather than speculation. And there are a lot of companies saying that they're limited more by how fast they can build than by the demand. The question that's worth watching from here really is, how long can this pace continue? Since spending at this scale, it has to be justified by a return on the investment. Now, if you look beneath the headline rally in tech, the Q2 gains were pretty broad. This slide is really looking at the year-to-date total return, which includes both price gains and dividends across 5 different parts of the market. The answer is actually pretty encouraging with the strength of this year. It extended beyond just large cap tech companies. Starting on the left, the S&P 500 gained about 10.2% this year. However, if you strip out the tech sector, and the return declines to 5.1. The gap shows how much of the headline returns this year have come from a pretty narrow group of tech stocks. And those are the very companies we described on the previous 2 slides. Moving to the right, you can see the strength across the broader market. The remaining market segments in the chart produce double-digit returns, outperforming the S&P 500. So the S&P 400, an index of mid-cap stocks, and international stocks have both returned more than 15% year-to-date, and the small-cap Russell 2000 has gained 22%. The performance gap, that's actually a welcome sign because it means the broad market's gains, they're broadening rather than resting just on tech stocks alone. Smaller companies underperformed in recent years, and that's because inflation rose and the Federal Reserve raised interest rates. The index is tracking small cap and international stocks. They also don't include the big AI names that have dominated the headlines, which caused them to underperform those large cap indices. The group's participation and outperformance are a positive development, and that really means it's an indicator that the market breadth is improving. It's also important to remember why portfolios are built with diversification in mind. By holding on to a mix of market factors, company sizes, and geographies, an investor doesn't have to depend as much on a single part of the market to do well, which can help smooth out performance over time. In a year when the headline index has leaned so heavily on tech stocks, that diversification has been quietly doing its job. I will say that corporate earnings, a big piece of the falling interest rates, that's what's lifting those small cap profit margins. So when we turn to this slide, we're looking at corporate profits, specifically the profitability of America's smaller companies. This chart is graphing a rolling 12-month net profit margin of the Russell 2000. This is an index of roughly 2,000 small cap stocks. A profit margin measures the share of each sales dollar a company keeps as profit. So a higher margin means a more profitable business. Smaller companies tend to be more sensitive to the economy and to interest rates, which makes their margins a more useful gauge of broader business environment and corporate profitability. Now, here's the thing. Small cap profit margins, they move in cycles. Margins historically decline during periods of economic stress. Think about things like the 2008 financial crisis when they turned negative. Profit margins stabilized through the 2010s, but they weakened again during the pandemic because the global economy shut down. Those margins rebounded in 2022 as the economy reopened, financial conditions improved, with the Russell 2000's margin peaking near 4.8%. But the period from 2022 to 2024 was difficult for smaller companies. Here's why. Inflation rose to a 4-decade high. This forced the Fed to raise interest rates sharply, and small cap profitability weakened as margins is compressed all the way as low as 2.7% in late 2024. The reason smaller companies were hit harder than the large ones, it's because they tend to carry more floating rate debt. So their borrowing costs climbed as the Fed raised rates. Many larger companies, by contrast, they've locked in long-term financing, and so they were largely shielded from the rate hikes. Now, margins have recovered since late 2026, and they currently sit around 3.6%. The same forces that squeezed small companies are now easing. Inflation has come down from its highs. The interest rate burden that defined 2022 and 2023 has faded as the Fed cut rates. Those savings are flowing back into the profits of companies that were borrowing at those floating rates. And one of the fundamental reasons behind the renewed interest in smaller companies from the prior slide, the durability of the margin recovery, that's really going to depend on part on the path interest rates go from here. But the trend so far has been encouraging, and it's one of the reasons that the market has started to broaden beyond just the largest companies. So I think it's important to take a peek at Inflation Monitor and see what kind of price pressures where things stand. And so let's look here. Price pressures are set to ease as oil reverses lower. Now, obviously, there's a question about what's going on with Iran, where we're sitting today, and this has not been settled yet. But this chart here brings together two of the most economic important stories of the year. That is around oil and inflation, because they're really one story. The chart on the left, this tracks the price of oil in the first 6 months of 2026. The chart on the right tracks the year-over-year rate of inflation. The connection between them, it is direct. When oil prices surged earlier this year, they pushed inflation up to a 3-year high. Now that oil is falling back, inflation is expected to follow it lower. The chart on the left, it's graphing the price of WTI crude oil. That's a pretty common benchmark for US oil prices over the past 6 months. Oil started the year in the upper 50s. Picture changed abruptly in late February. Remember me talking about that in our last video? The conflict in the Middle East and the resulting closure of the Strait of Hormuz. This was a critical shipping route. This is where a large share of the world's oil flows, and that created major oil supply disruptions. Obviously, we saw energy prices spiking immediately. Oil peaked near $115 in early April. You can see from how jagged this line is that the months that followed, they were extremely volatile. Prices swinging on each new headline out of the region. The most important part of the chart, though, is the right side, which is right here. As tensions eased late in the quarter and the strait started to reopen, oil fell back to pre-conflict levels. Again, the chart on the right graphs the rate of inflation. Now, this is measured by the Consumer Price Index, which tracks the prices of goods and services that households buy. Inflation peaked above 9% back in 2022. Then it fell steadily over the following years before settling in the 2.5–3% range. However, the spring spike in oil prices, that caused inflation to rise up to about 4.2%. That was in May. It was its highest level in 3 years. This cause was almost entirely the jump in oil prices shown on the left, since energy touches nearly everything via transportation costs. One important thing to keep in mind here is that inflation data looks backwards. The May reading, it captures the time when oil was near its peak, not where oil is trading today. So when you're pulling these two charts together, it tells an encouraging story. The rise in inflation was driven by oil, and since oil has now fallen back to where it started, inflation is widely expected to ease in the months ahead. Of course, that's contingent upon the current environment. It's directly impacting the Federal Reserve. The oil-driven jump in inflation is a major reason that the Fed shifted from considering rate cuts to weighing a possible rate hike. So the recent decline in oil should help relieve some of that pressure, but it's a lot of unknowns. The Fed is likely to remain very patient and hold rates steady in the short term, but a sustained move lower in oil and inflation would give the Fed more room to set policy later this year. The key question from here is whether the next few inflation reports confirm that inflation spike is rolling over. So let's take a shift slightly and talk about the labor markets. Here's the thing. When we focus on the labor markets, which is the second half of the Federal Reserve's mandate along inside inflation. So a lot of people know the Fed is looking at inflation. That's a big part of their mandate. Another one is the labor markets. So the Fed is charged with keeping both prices stable and promoting full employment. With the two mandates, sometimes they are in conflict and they require the central bank to prioritize one over the other. The two charts indicate labor market conditions are improving. That was after they softened in late 2025. The chart on the left, this is graphing the monthly change in non-farm payrolls, or the number of jobs the U.S. economy added or lost each month. It shows the pace of job growth declining throughout 2025, and that included several months of job losses, which is a sign of labor market softness. The softness carried over into early 2026. This was when the economy lost about 156,000 jobs in February. However, the trend has reversed in recent months, with monthly job growth averaging about 188,000 in the 3 months from March until May. The chart on the right graphs the unemployment rate, and it really tells a pretty similar story. The unemployment rate, it was drifting steadily higher during 2025, and it reached a peak of 4.5% in November. This was the highest level in 4 years. But think about this. As job growth reaccelerated this year, the rise in unemployment stopped and it partially reversed lower. Unemployment fell back to 4.3% in March, and that's where it's held steady for the past 3 months. Now, these two charts indicate that the labor market conditions have improved this year, with more jobs being created, unemployment drifting lower. The improvement is good news for the broader economy because a healthy job market that supports consumer spending and it signals more economic strength. It also connects back to the Federal Reserve. Employment is half of that Fed's mandate, and a strengthening job market reduces the pressure on the Fed to cut interest rates to support the economy. With both halves of the Fed's mandate pointing the same way, and this is the key thing, I don't want you to miss this. With both half of the Fed's mandate pointing the same way, with the rising job growth, the rising inflation, the case for near-term rate cuts has considerably weakened. So when you look here, those interest rates, expectations, rate cut, flip to a possible rate hike. Well, why? This is focusing on the Federal Reserve and the path of interest rates. So you see a sharp reversal in the market's interest rate outlook during the first half of the year. The line on the chart, this shows where the market expects the federal funds rate. This is the Fed's benchmark short-term interest rate to finish in 2026. It's drawn from the futures market, which lets us see in real time what investors are thinking the Fed is going to do. And what makes it notable is the direction of travel. The market began the year expecting the Fed to cut rates, and it ended the second quarter expecting the Fed to raise them. So to read the chart, the key reference point is today's federal funds rate, and that's sitting in a range of 3.5% to 3.75%, and it hasn't changed all year. At the start of the year, the market expected the Fed's benchmark rate to fall back to about 3.06 by year end, and that was about 0.5% or two interest rate cuts of 0.25% each in 2026. Forecast started drifting sideways for most of January and February, but it has climbed since early March. That was when the Middle East conflict started. By the end of the second quarter, the market now expects the Fed benchmark to end the year nearly at 4%. That would be implying a rate hike. In a matter of months, the market went from anticipating rate cuts to anticipating a rate hike, and the Fed's own projections in June, they have shifted in the same direction. Now, several themes contribute to the repricing. One, the Fed tends to cut interest rates when the economy is slowing and needs support, or to hold or raise them when inflation is running too high, or when the economy is growing at a solid pace. Coming into the year, there was a belief that a softening economy would cause the Fed to rate cuts. Instead, the opposite has happened. Inflation rose to a 3-year high, and that was driven, yes, primarily from a jump in oil prices due to the Middle East conflict. But the economy has remained resistant with steady hiring and low unemployment. In other words, the Fed lost both reasons to cut since the economy has continued to expand and the room to cut since inflation is rising. So I think it's worth putting the scale of the forecast change into perspective. Here's the expectation is that if the Fed does raise interest rates, it's more of a modest recalibration than the start of another aggressive hiking cycle like they did in 22 and 23. The oil price surge behind most of the recent inflation, it's already been reversed as tensions in the Middle East have eased. I say that today, tomorrow tensions could have rise, and then they may fall again, but this is likely to relieve some of the pressure on the Fed to act. The bigger picture here is a shift in expectations and the potential for interest rates to remain near current levels longer than a lot of people expected. Now, this is going to have second order effects worth keeping in mind. Borrowing costs on things like mortgages and loans could remain elevated, but the same backstop or backdrop, that means savers can continue to earn attractive yields on bonds, CDs, and cash, which is a positive for anybody relying on their portfolio for income. Now, when we look at this IPO activity, this is a developing trend in the financial markets, and it's this. There has been a sharp increase in the supply of new stock and debt. And that means the amount of new shares and bonds companies are selling to investors has gone up. The chart is graphing the total money raised through IPOs, or initial public offerings. That's when you first take a stock to the market each year. So an IPO, it's the process by which a company sells those shares to the public for the first time. Then it's trading on a stock exchange. And we've seen an interesting thing where we've had several quiet years, and IPO activity has really come roaring back in 2026. And it's part of a broader trend that I think is worth understanding. Part of it is this chart is graphing the cumulative proceeds from IPOs by calendar year. This shows how IPO activity fluctuates from year to year. You notice that activity surged to a record of nearly 245 billion in 2021. That's when markets were booming, money was cheap. It collapsed just as quickly, falling to less than 12 billion in 2022. This was as rising interest rates effectively shut the IPO window. Activity remained muted in 23 and 24. It began to recover in 2025. Year to date, companies have already raised about $131 billion through IPOs. This is the most in any year since 2021. Now, it should be noted that that figure only covers part of the year, and there are still several large companies still preparing to go public. So I think 2026 is shaping up to be a busy year for new listings. This rebound is being driven by two forces. The first one is a group of large, well-known private companies that are choosing to go public. The standout was SpaceX. They completed the largest IPO in history in June. They raised about $85 billion. There are several other large private companies that are expected to follow. Two of the most prominent are names in artificial intelligence. That would be OpenAI and Anthropic. They have been widely discussed as potential candidates to go public later this year or early next year. The increase in IPO activity, though, is related to a secondary force. Capital raises to fund the artificial capex, or artificial index capex, rather, that we discussed earlier. The largest technology companies, and these are things like Alphabet, Meta, and Oracle, they are spending so heavily on AI data centers that that spending is consuming their cash flow, and it's forcing them to raise large sums of money in the capital markets. So most of that has come through borrowing, but a growing share is coming from issuing new stock, which adds into the supply of shares. The takeaway here is this: that a significant amount of new stock and debt supply is coming to the market. It's a notable change because we've had several years of subdued activity, a reopening IPO market that gives investors access to companies that were previously available only to private investors. It's also a sign of a healthy, confident market. That's where capital is flowing more freely to fund growth and innovation. For long-term investors, more companies going public means broader opportunity set and a wider range of businesses to potentially invest in over time. The question that comes with this is, with this much new supply, is whether the market has enough capacity and demand to absorb it. The recent IPO with SpaceX shows that there's a significant amount of demand, but a lot of it depends on financial conditions and the path of interest rates in the months ahead. For now, the surge in issuance, it's really best understood as the market kind of reopening for business after a quiet couple of years. And it's just one more sign of how much capital is flowing towards the AI build out. Take from that what you will. Now, here's the thing I want you to look ahead. Key themes to watch in the next 6 months. As we wrap up this webinar, this slide, it really highlights the three key themes that we're going to be watching more closely in the second half of 2026. We touched on one of them already today. So think of this, we touched on all three of them already today. So this is more of a summary of the open questions that are likely going to shape the months ahead. Each one of them is unresolved, and how they play out is going to go a long way towards determining the path of the markets and the economy into year end. How aggressive you are as an investor and your appetite for volatility definitely is going to impact how comfortable you feel and the investment strategies that you employ moving forward. Because the first theme is the path of inflation and interest rates. Inflation rose to a 3-year high during the quarter. And that was driven almost entirely by the spike in oil prices. Now, energy costs have since fallen back to pre-conflict levels as the Strait reopens, and the expectation is that inflation is going to ease in the months ahead. The question is whether the cooling actually materializes. If it does, it could relieve the pressure on the Federal Reserve and make the case for rate cuts later this year. However, if inflation proves stickier than expected, the Fed could raise interest rates instead. This matters because those interest rates, those influence everything from mortgage and loan costs to the yield that savers are earning. The second theme is the AI build out. The spending behind it has been astronomical, and the gains in the stock market have been big. The question is now whether both can hold. The AI trade has been popular, and the late quarter pullback in technology, it shows just how quickly stock prices can swing when expectations are high. Over time, the spending will need to translate into real profits to justify the scale, especially as a growing share of it is funded by issuing new debt and stock. The past quarter showed the promise of the technology, and it served as a reminder of how much is already expected of it. And so the third theme is twofold: whether the stock market breadth remains strong and whether corporate earnings can live up to expectations. We noted earlier that small and mid-sized companies, they've begun participating alongside the technology giants, and their profit margins have been expanding. Heading into the second half, the question is really whether that broadening continues and whether companies can deliver the earnings growth investors are counting on. It is natural to look at this list of open questions and feel some uncertainty, but I think it's worth remembering how the last quarter unfolded. The stock market faced a war, an energy shock, rising inflation, a more hawkish Fed, and it still finished sharply higher. Through all of it, stocks not only held their ground, but they traded to new highs. We cannot know exactly how the questions are going to resolve, but I think this is where a diversified portfolio and a long-term perspective can help navigate periods of uncertainty. I want to thank you for joining us today, and we look forward to walking through this next quarter together. If you have questions, obviously you're able to get in touch, reach out. I always think it's a good call to talk with your advisors and run through things. I hope this has been insightful into the market themes that we've been following inside as we're working hard to manage your family's wealth alongside of our own. Thank you so much for joining me in this, and I hope you have a wonderful day.